Financial Reporting and Analysis CFA Level 1. Unleash your full potential with logic, visual stimulants, and audio stimulants. All you need to know about inventory in minutes. Inventories can be evaluated using 4 methods. Under IFRS and US GAAP, we have FIFO. First item purchased is considered as first item sold. Weighted average cost. The average cost of items purchased is the cost of items sold. Specific identification. A specific item sold has its own unique value. And under US GAAP only, we have the LIFO. LIFO method consists of the last item purchased is considered as first item sold. Remember that FIFO is LIFO plus LIFO reserve. Let's have examples. Trinity purchased 100 laptops, 30 of them at 1.1 for $1,000 each, 50 of them at 1.7 at $1,500, and 20 of them at 1.12 for $2,000. Trinity sold 20 laptops at 31.12.2022. Cost of goods sold recorded is. Let's first have an example of the FIFO method. Using FIFO, 20 times 1,000. Why? We have sold 20 laptops, but first in, first out. So the first purchase of 30 laptops is the cost, 1,000 each. And the answer is 20,000. Now using LIFO, last in, first out. What's the last in? 2,000. 20 times 2,000 equals 40,000. Using weighted average, we need to calculate the average of the costs of the laptops. We have 30 laptops at 1, 50 laptops at 1.5, and 20 laptops for 2,000 each. Divided by 100 to get the average, because we have 100 laptops, equals 1.45. 20 times the average equals 29. Now let's have specific identification. This is best for jewelry. Trinity sold 10 laptops HP, bought at 1.1, and 10 laptops bought at 1.7. So we have 10 laptops times 1 tau, and 10 laptops times 1.5 equals 25,000. Cost to include in inventory. Purchase price plus import and tax duties plus transport plus insurance during transport plus direct labor. Let's have an example. You purchased a laptop from Dubai for 1,000. To have it transported to your country, you paid an additional $200. It's included. And insured your laptop for $10 and paid tax for $40. To install Windows, you paid $50. So the real cost of inventory is 1 plus 200 plus 10 plus 40 plus 50 equals $1,300. Inventory ratios. Inventory turnover is cost of sales or cost of goods sold divided by inventory. Days of inventory on hand is DOH. It's the number of days in period, normally 360 or 365, divided by inventory turnover. Let's have a practice example. In a period of 365 days, cost of goods sold is 10,000 and inventory is 300,000. Calculate inventory turnover. Well, it's simply 10,000 divided by 300,000, and the answer is 0.033. Let's also calculate the days of inventory on hand. It's number of days in a period, 365, divided by inventory turnover equals 10,960. Remember to subscribe for more videos, and God bless your day.